Hello guys, welcome back to Investing Tutorial. Today in this exclusive video, we delve into the invaluable wisdom of Charlie Munger, renowned investor and vice chairman of Berkshire Hathaway, as he imparts his last advice for 2024. Munger, often regarded as Warren Buffett's indispensable partner, shares his unique insights on navigating the ever-changing landscape of the financial world. Drawing from a wealth of experience, he provides strategic advice on investment principles, decision-making, and adapting to the dynamic market conditions anticipated in the coming year. Join us as we explore Munger's timeless principles and gain a glimpse into the mind of one of the most respected figures in the world of finance, offering invaluable guidance for investors and enthusiasts alike in the year ahead. A month shy of turning 100, Charlie Munger sadly passed away in November 2023. Fortunately for us investors, a few weeks prior to his passing, Becky Quick and the CNBC team were able to sit down with Charlie for almost 2 hours to discuss his 80-plus years of investing wisdom and how he thought investors should think in 2024. I basically believe in a soldier on system. Lots of hardship will come, and you got to handle it well. The most crucial information from Charlie's last TV interview is examined in this video, along with how it relates to investors who want to live to 100 years old in the coming year. Everyone is curious about the secret. What is your secret? Why don't you know the secret? I avoided the typical ways of failing because my life's mission was to stay away from all typical failure paths. If you teach me the incorrect way to be a baker, I'll stay away from it. Naturally, I have a lot because I'm very cautious. I also want to give the leaf blower in that clip a lot of credit. Yet there is a really valid point to be cautious and stay away from the typical reasons why things fail. People often view the stock market and believe that taking risks and living dangerously is the way to make it big. But in reality, this couldn't be further from the truth. The best investors are all extremely risk-averse. Time and time again, it's the extremely cautious and risk-averse investors who emerge victorious. Charlie has always been a firm believer in the idea that doing the right thing is more important than doing the stupid thing. Buffett's first investing rule is to protect your downside risk. This will be crucial in 2024 as speculation and euphoria re-enter the market. Of course, there will be some FOMO, but we must exercise caution and carefully consider the companies we choose to invest our hard-earned money in because interest rates and debt levels are so high. The greatest tennis player ever has a bad day on the center court. It happens. I believe that sometimes people learn more from their mistakes than from bad days. Yes, but what they really need to know is that you can have a very bad day. Don't live your life in a way that makes a bad day kill you. This means that when it comes to investing wisely, you can still have good days. Their target is the fences. It's comparable to a baseball hitter who needs to knock a home run on every pitch. The ultimate home run hitters. Wait for a pitch that they can truly handle rather than remotely swinging at everyone. Excellent stockers also do this. In a similar vein, Warren Buffett compares investing to a fascinating game of baseball in which you may stand at the bat and see Nvidia pass by at 1.2 trillion. You can watch as Google passes Silicon Valley Bank and Tesla passes 600 billion. We will undoubtedly let that one go through to the keeper. You can simply keep letting these quota prices pass until, perhaps in 6 months, you find that perfect pitch for Google or Microsoft at a 50% margin of safety. Once you have that perfect pitch, you can swing hard. And Charlie mentioned in that clip that investors these days have a huge tendency to swing at everything. That's not a smart trade, and it will be especially risky in the high interest rate environment of 2024. If you just keep swinging, you might eventually hit a ridiculously overvalued tech stock, or you might hit a stock that is almost certain to crash due to its newly discovered debt. And neither of those scenarios is good for huge stock market returns. You may be wondering if it's harder to make money these days. Well, that's an important question, and it is undoubtedly harder, so much harder that you won't believe it. But the people who have found it hardest are the ones who have made Warren so wealthy in the last few years of his life. So hold on to your perfect pitches because good opportunities are more scarce than ever. Charlie repeatedly emphasized that investors today must realize they are playing a very different game and that it is much harder to succeed. There is also greater scrutiny from investment professionals, and analysis is much easier. All of this results in investment opportunities being found more quickly and for a shorter period of time, which is unfortunate, but it's not all doom and gloom. On the plus side, he also points out that those who make things much harder for investors like Warren Buffett are typically the ones who provide them with opportunities. Because of the stock market's manic-depressive nature, most people lack the patience to locate them in the current environment. When interest rates, for instance, are although high inflation is still present, consumers are beginning to deplete their reserves. Although there are indications that opportunities might arise, it's simple to give up and make an absurdly expensive investment when you see the S&P 500 surge ahead, led by the Magnificent Seven. In contrast, it can be simple to panic and sell a good company when the market is collapsing like a brick. But it is precisely this illogical behavior on the part of the short-sighted that ultimately presents opportunities for value investors. Equity prices are usually irrationally impacted by mass euphoria or panic, and this phenomenon is not going away anytime soon. Seth Klarman also discusses this, stating how, in general, Meta, one of the biggest and most scrutinized corporations in the world, offered him an extremely alluring chance into 2022. Charlie believes that the current market is much more competitive, which he attributes to the growth of value investing. What makes value investing so intriguing, in Charlie's opinion, is that he taught people that you should find a few good things and stick with him for a very long time. A long time to him wasn't measured in decades, and that even if a business is bad, but it was cheap enough, they are still right if they have enough assets for share, meaning that you would receive at least twice as many assets as you paid for. That was his method. As a result of his 50 years of hard work and his clan's strong returns, he became extremely well known. Naturally, everyone wanted to emulate him, and as a result of his success, competition grew. This is exactly what happened over time as value investing gained popularity and the field of investment analysis advanced. It became more difficult to purchase these large baskets of cigar stocks, which increased risk and decreased the strategy's viability. For those who continue to pursue less diversification, Charlie Munger revolutionized the field and created a cutting-edge approach to value investing. He discovered that simply hopping from one cheaply constructed, subpar company to another, paying all associated expenses, doesn't generate enough returns to compel investors to invest their money. Instead, you should focus on finding quality companies. The strategy that Buffett and Munger used to grow the majority of Berk's wealth is still the best active investing strategy available today. I saw right away that Grandma was wrong, and you looked for and had the real money in the really great companies. These days, it's rare for decent businesses to end up with bargain basement prices, especially in an environment with high interest rates. Therefore, instead of searching for a last-minute deal, look for companies that may not be at bargain basement prices, but they do have characteristics of a very good business, and hold on to these companies for a very long time. Many of the companies that were placed in the bargain basement bin last year were there for good reason. For instance, Silicon Valley Bank's shares weren't in the bargain basement because they were in the bargain basement for their final plunge, which was made because the company was going out of business and had sustained irreversible damage. On the other hand, Work shares weren't in the bargain basement bin because they had a single terrible year due to the pandemic. Essentially wrecked the company's business plan because of the increased scrutiny of businesses and financial markets these days. FTX shares were not in the bargain basement because they had a bad year. Rather, they were there due to egregious mismanagement and fraud. It's unusual to discover really cheap companies that have simply had a few terrible years. The bargain basement stocks are there for a very solid reason, and they might not even have one more puff. Monitoring the financial health of the company and, consequently, its quality is crucial. This is what has made Charlie and Warren such successful investors. It surprised me that despite our modest beginnings, Warren and I would ever reach $100 million, let alone several $100 billion. It was an incredible event. What made us successful then was that we became a little less crazy and a little less stupid than most people. Furthermore, we had a much longer run than most people because of something that kept us alive well into our 90s. These two events are what actually happened. We went from a little piddling start to the 1990s. Of course, we learned our lesson over time, entering better and better companies and becoming increasingly aware of the potential risks. As a result, we avoided these risks even more diligently as we grew older. All of this worked out. 3 points to remember from this video. Manage your emotions and never act rashly or foolishly with your portfolio. And be as simple as it may sound, learn from your mistakes and don't make the same ones again. Simply let your investments to grow over time, and yes, it is the fundamental principle that starting early and today is the best day to start. The more important lesson from Charlie and Warren, though, is to keep onto your investments for a long time rather than getting caught cutting and changing them. This goes beyond simply investing over a lengthy period of time. Identify and stick with the long-term compounders. The primary trick that Buyer demonstrates is the power of what I refer to as the Wooden effect. Wood was the most well-known basketball coach of all time, and you can figure out what the hell he really did. Of course, Warren and I just naturally do it, by focusing on 7 players for about 90% of the playing time, with everyone else serving as the people's sparring partner. Naturally, it worked better, and everyone learned it, but when it comes to investing, people assume that anyone who attends Harvard, Columbia, or another university can learn it. However, this is untrue. Like chess, mechanical aptitude, or many other skills, it takes a seasoned professional with a natural aptitude to succeed. In the world of investing, only a small percentage of outliers make the big bucks, and Charlie is exactly right. These days, the majority of active investors will not make money over the course of their lifetimes. Only a small number of people will perform well, including those who regularly analyze businesses and those with strong investing temperaments. This is because, based on my observations, these individuals are the ones who can not only identify 6 or 7 good businesses over the course of their lifetimes, but also maintain a long-term commitment to them. I won't harp on about this too much because I've talked about it extensively over the past 12 months, but let Charlie explain. If you take away the 10 most significant trips that Warren Buffett made to the pie counter, his entire record would be worthless. You have to learn to spot these trips when they arise and avoid making too many trips to the V counter when the opportunity arises. In the same vein, Warren Buffett attributes Burr's success to roughly 12 wise investments that he just persisted with. At Naspers, Cus Becker placed a wager of 10 cents and stayed with it. Nick persisted with his sleep bet on Amazon. Even Ben Graham, who persevered and bought half of Gecko, unintentionally discovered his biggest achievement. I've been focusing a lot on this personally, not so much on getting caught up in the flashy opportunities that occasionally arise in the stock market. Time and time again, the stories of these extraordinarily successful investors come down to spotting a winner waiting to strike and then holding on to it and allowing it to compound. Instead, I will stick to my expertise and experience to identify those companies that do have a long runway and will wait patiently for a reasonable price in those long-term compounders. What's interesting to me about Charlie's interview is that, looking back, Charlie acknowledges that Berkshire could have been much larger if he and Warren had taken a slightly different approach. However, pay attention to the explanation for their decision not to proceed with this round out. With a little bit more leverage, which was readily available in retrospect, Berkshire might have easily doubled in value from where it is today, and the additional risk we would have taken would have been negligible. You're glad you didn't just because of the potential risk. It's an interesting example of why we didn't. We didn't want to let many people down who had put their trust in us when we were young. If we lost 3/4 of our money, we would still be extremely wealthy. But that wasn't the case, because losing 3/4 of the money would have been a major disappointment for each shareholder. As a result, we were extremely cautious when handling our share of the money. They could have used some leverage, but ultimately, the most important rule is to never lose money. Taking unnecessary risks in the hopes of achieving higher returns is never worthwhile. In summary, I believe Charlie made 5 important points that we should definitely keep in mind for the upcoming year. First, there are sadly fewer opportunities today. Therefore, we must wait patiently for the good ones. Secondly, even though it may be tempting to invest right now, investors should exercise caution and carefully consider what they are purchasing. For example, they should look into the debt and interest costs. Next, look at the cash flows. The third, since many businesses are trading in the bargain basement bin for good reason, keep in mind that it's preferable to purchase a fantastic business at a fair price than a fair business at a great price today. Then comes number 4. Once you've found a long-term compounder, hold onto it and allow it to grow. Recall what Buffett said about holding on to the big winners. Without doing so, his portfolio isn't all that special. Lastly, number 5. Just keep going. Charlie's success was largely the result of his perseverance. The key to success in the stock market is perseverance. If you make a mistake, don't give up. If you're not finding good possibilities, don't give up either. Holding on for a long period is essential. In closing, Charlie Munger's wisdom is a beacon in the sea of life's complexities. As we reflect on his last piece of advice, let it serve as a guiding light in our own journeys. Embrace the power of continuous learning, cultivate a diverse set of mental models, and approach challenges with a curious and rational mindset. Munger's legacy is not just in his words, but in the lives influenced by his principles. Let's carry forward the torch of knowledge, wisdom, and integrity. If you found value in this video, please like, subscribe, and share it with fellow seekers of insight. Here's to applying Munger's timeless advice in our pursuit of a more informed and fulfilling life.